Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at EAT, or Brinker International Inc. EAT primarily owns, operates, develops franchises various restaurants under the Chili's Grill and Maggiano's Little Italy brands. Here's the barchart.com technical opinion rating for EAT. The bar chart rating is a 100% buy with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, the stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that EAT is well above the moving average line, so the monthly trend in EAT is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line is above the green line, so the daily trend in EAT is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. EAT is below the upper Keltner channel line, so EAT is inside the buy zone. Since the trend is up, we want to buy a call. EAT has 8 option chains to choose from. We're going to use the August 15 chain. Right now, the August 15 options have 47 days to expiration. Here's most of the EAT option chain for August 15. EAT closed at 180.05 on Friday. That means any calls on the list from 115 to 180 are in the money. Let's take a look at the profit potential for purchasing the 180 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 180 call is 1310 to 1590. We try to enter near the midpoint, so we'll use 1450 as the buy price. Our call option calculator shows the profit potential for this call based on EAT price changes at option expiration from flat to a 12.5% increase in price. We can see that if the EAT stock price is flat at 180.05 at option expiration, the 180 call will lose 99.7% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 155 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 155 call. According to the 1% rule, we want to call to at least break even if the stock price is up 1%. The calculator picture shows that if the EAT stock price is up 1%, the 155 call will lose 13.4% of its value. We want that to be break even or better, so the 155 call does not meet our requirements. Let's see if the 130 call will work. The bid-ask spread for the 130 call is 50.70 to 53.40. We try to enter near the midpoint, so we'll use 51.80 as the buy price. The 130 call works. If the EAT stock price is up 1%, the 130 call will make a 0.1% or $5 profit. That's better than break even, so the 130 call is the one we'll buy. The call option purchase calculator also shows that if the EAT stock price increases by 2.5%, the 130 call will make a 5.3% or $275 profit. If the EAT stock price increases by 5%, the 130 call will make a 14% or $725 profit. If the EAT stock price increases by 7.5%, the 130 call will make a 22.7% or $1,175 profit. The plus 10% and plus 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the EAT stock price does not make the expected move up and remains flat at expiration, the 130 call would only lose minus 3.4% or minus $175 compared to the minus 99.7% or minus $1,445 loss for the 180 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the EAT August 15 expiration 155 strike call and sell to open the August 15 165 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 155 call for 31 even and sell the 165 call for 23.50. 31 even minus 23.50 equals 7.50, so the entry price or debit cost for the spread is $750. The call option spread analysis calculator picture shows that the spread will make a 33.3% or $250 profit if the EAT stock price declines by 7.5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect a $2,350 cash credit to our brokerage account for the sale of the 165 strike call. As we said on the previous slide, this reduces the cost of entering the spread to $750. Here's a note regarding earnings reports. The next EAT earnings report is scheduled for August 13th. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the EAT August 15 130 strike call for 51.80. We also reviewed a spread. The spread said to buy to open the EAT August 15 155 strike call and sell to open the EAT August 15 165 strike call at a debit of $750. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week. Thought he escaped. Oh, there we go.